Hey, welcome back to Heinz and Clark podcast. Actually, we're doing two videos today, so you'll see another one come out later on. And if you're wondering why we're wearing the same clothes as we were in the other one, it's two today.
We kicked Ethan out though, who's the third person.
Yeah.
So
if you didn't watch that other one, you have no idea.
now
what
you
we're
should go
talking
watch
about.
it. You'll have to watch it.
But
Suspense.
but today we're going to be talking in this video about the employee retention credit or ERC credit. If you have or haven't heard about it, a really great credit that and lucrative is the word that I read a lot about it. And we're talking about it because originally we didn't think it applied to as many businesses and as broad a range of businesses as we originally thought, and as we have learned a lot more about it. We think it's a really lucrative and valuable credit that a lot more businesses apply for. And so we wanted to get it out to people and let them know more about it. And I'll let Steve introduce more of that.
Yeah. So maybe what is the employee retention credit? So it's a payroll tax credit essentially that for the purposes of kind of the COVID relief was created or adjusted to allow businesses to take a credit on their 941 payroll tax returns for quarters essentially 2, 3, and 4 of 2020 and quarters 1, 2, and 3 of 2021. There's some limits on the amount. It's essentially up to $10,000 in wages. For 2020, it's 50% of wages up to $10,000 for the year. So max credit per employee is $5,000 for 2020. And for 2021, it's a max of 70% of wages up to $10,000 per quarter per employee. So it could be $7,000 per quarter per employee for 3 quarters. So a max for 2021 of $21,000. So if you combine that with the 2020, so it's up to $26,000 credit per employee that you employed during that time. The kind of big shift, if you will, is how businesses qualify for this. So there's a gross receipts test, or if you had a drop in gross receipts, and it changes throughout 2020 and 2021. So if you had a drop in revenue, good chance that you might qualify that way. If you don't, there's another way that's much more broad, and it's essentially if you were impacted by a governmental order. A governmental order can come from the federal, state, or local level as well. So even if your county or city put in a government order that affected your business, it could be it affected your business in a variety of ways. I mean, some things we're seeing are supply chain issues, things related to employees. You know, if you're a manufacturer and you had to change and add additional shift because you couldn't have people as close, and so now you needed to have 3 shifts instead of 2 shifts. If your business was shut down, if you worked with businesses primarily that were shut down, right? Parties were essentially stopped for almost a year or two, right? We have a couple of businesses that we've applied for this credit that sold things or services to specifically for parties, and so that business essentially went away, right? Or was greatly affected because of this. So we've even had some clients who had good years and maybe even better years than they had leading up to COVID that still qualified. So we're not going to get into too many specifics on this, but it's more to get this kind of word out there. And we would encourage you, if you've had employees during that time and there's a possibility you think you might qualify, to give us a call so we can talk through it. And I think kind of the way I look at this, I think Aaron is very similar in kind of how our firm is taking this, is that it's a conversation to have, right? And so there's a lot of unknown about some of this, and the way I kind of look at it is you can claim a credit. There's all kinds of credits that you can claim on tax returns. You can claim a deduction, all kinds of deductions on tax returns. You're never 100% sure if that is going to fly, right? I mean, the IRS could always audit you. There's always a little bit of risk associated with everything that you claim on your tax return. And this is really no different. Now, the amount of risk that you take is probably dependent upon the type of industry that you're in and how affected your business was by these things. And so typically what we do is we talk through the various components with our clients. We have them draft up something relatively short in how their business was impacted so that we have that on the front end. So when you file these tax returns, it's essentially you're amending your payroll tax returns. They're going to send you checks for them, and there's a chance you could get audited, right? And so if you're audited, we want to make sure that, one, we've calculated the credit correctly for you, because there's some components to it related to PPP and some other things too. So it's not a simple calculation. It can be a little bit more complex. But then also that if you are audited, we have documentation on why we feel like your business qualified for this, and that we can provide that on the front end. I've heard some people say, well, because we've had businesses that have gotten PPP1, PPP2, and the ERC, and they also had great years. And I'm not one to sit here and judge whether or not that's something that is right or not. I think it's kind of for each person to kind of make their own decision on if they feel like they are. But our job is to help the client understand if they qualify, and if we think they qualify, and essentially how much risk potentially they're taking in applying for this credit.
Yeah, I think to some of that, my mindset has shifted over time in looking at this and really identifying and kind of wrapping my mind around why so many people actually or businesses qualify for this, and really the understanding of how much we all were impacted by COVID. And I was giving an example to a client who was they weren't really sitting on the fence, but were just kind of wondering, like Steve said, they had a good year still. But and why are we confident? Why should they be confident in why they qualify? Is all of the things that they did to pivot and adjust to COVID, to make sure that their business could continue to operate and find ways and solutions around this. They were big impacts on their business. And just because they still had a good year doesn't mean that COVID wasn't a major impact on their business. So we've really broadened our scope and think a lot of businesses qualify, and outside, restaurants, manufacturing,
anybody that was shut down.
And anybody shut down. That one's a very easy one. So if you do have questions on this, or wondering, do I qualify? How do I go about figuring it out? Reach out. We'd love to answer questions. We'd love to help you and just kind of facilitate working through the process of.
Yeah. And I think to maybe piggyback on something that you said about, just about every business was probably affected by COVID in some form or fashion. I think one of the keys is that you do have to be able to relate it to a government order. Mm-hmm. And we have a list of all of the government orders here in Minnesota. We have a list of all of the ones that, from a federal level. And then we can also look them up, the county and kind of city level as well too. So really and a lot of our clients are going to go through the same type of things, right? So a lot of these things we're going to know pretty early on that you qualify and why. And so if not, then we can do a little bit more research to try and see if you do qualify. And like I said, then, like I said, we can't provide 100% assurance on any of this. There's still a lot of, I even saw yesterday that the courts and the IRS are actually fighting about some of the guidance the IRS put out about this. And the courts are saying that's actually not following the intent of the law that was passed. The IRS is being more strict on it than what the courts were saying. So, we don't know what's going to come out of this. I would also say that I just learned this yesterday actually, that they've waived penalties associated with this. So if you claim the credit and then you're audited and they find out that you didn't qualify after you kind of go back and forth with them, you essentially just have to pay back the money. You don't get a penalty on top of it. So I'm not saying that that's a reason to do it. I'm just saying it should help ease the scariness of some of this that I think some of our clients have had in the past. And that I think we've seen change now since we've had these conversations. So I think, like Aaron said, this is meant to drive that conversation. So if you have questions, let us know.
Yeah. Cool. That
All right.
sounds good. Give us a call.
Thanks.
And then, like we always say, click. Are the socials around here? Do we click those, like those, follow us, watch our videos?
Watch all of them. Yeah.
All of them. Do it in one session. Goes quick. Cool.
All right. Thanks.